Welcome to The Explainer. The market has been, well, let's just say it's been a wild ride. But ARK Invest's Cathie Wood has a pretty bold and very different prediction for what's coming next. So today, we're going to break down her contrarian view on where the economy is really headed.
All right, let's just get right to it. The big question on everyone's mind. With all this uncertainty and nervousness in the market, what is actually going on? And, when is it going to pass?
So Cathie Wood and her team at ARK Invest, they see the discomfort we're all feeling. But their core message is, hang on, this is temporary. They're arguing that the pressures driving the market down right now, well, they have an expiration date.
So here's the crucial point from ARK's perspective. They believe the problem isn't some deep, fundamental flaw in the economy. Nope. They say it's more of a technical issue, a short-term squeeze on liquidity. Basically, a whole lot of cash has been temporarily sucked out of the financial system. And where did all that cash go? Well, according to ARK, it's a three-pronged issue. First up, the Fed kept its foot on the quantitative tightening pedal longer than folks expected. Then you've got the U.S. Treasury, which is basically hoarding an unusually massive pile of cash. And to top it off, the Fed is still shrinking its balance sheet. You put those three together, and it's like a vacuum cleaner for money in the system.
And this number, wow, this really shows you the scale we're talking about. The Treasury is sitting on nearly $1 trillion. That's more than $300 billion above its normal cash balance. That is a huge chunk of money that's just not circulating in the economy right now.
Okay, so this whole liquidity problem, it actually feeds into a much bigger debate that's driving all this uncertainty. It's this fundamental disagreement about what we should really be worried about long-term, inflation or deflation.
You've got two completely different camps here. On one side, you have the Federal Reserve, and they're laser-focused on inflation being sticky. You know that it's just not going to go away easily. But on the other side, you've got ARK, and they're saying, wait a minute, you're completely missing these incredibly powerful long-term deflationary forces, which are mostly coming from new technology and innovation.
And this is where it gets really interesting. To back up their view on deflation, ARK is pointing to a historical indicator that is flashing a signal we've only seen twice before in modern history. And both times, it meant a massive market shift was right around the corner.
So what is this magic indicator? It's the ratio of gold's value to something called the M2 money supply. And don't worry, M2 is just a fancy way of saying all the cash and easy-to-access money in the economy. Now here's the kicker. The last two times this ratio peaked, once in the 1930s and again around 1981, it was like a starting gun went off for a huge market recovery. We're talking a major bull market for both stocks and bonds. For an investor, seeing this signal today suggests that the very things that have been beaten down could be on the verge of a historic turnaround.
Okay, so if ARK is right and deflation is the real story here, what's going to be the spark? What's going to kickstart this market recovery? Well, they've identified two major catalysts that they see on the horizon.
The first catalyst is something we've all been watching, the Fed eventually ending its quantitative tightening. But the second one, this is the one that might be even more powerful, and it's a huge stimulus that's kind of hidden inside our recent tax policies. This stimulus has a name: accelerated depreciation. So what the heck is that? Well, think of it this way. Normally, if a company buys a big piece of equipment, they have to write off the cost over many years. But new policies are letting them deduct 100% of the cost of things like manufacturing gear, equipment, and even R&D in the very first year. It's like a massive shot of adrenaline for investment.
And the impact is just staggering. I mean, look at this. The official, on-paper corporate tax rate is 21%. But because of these new depreciation rules, the effective tax rate for companies that are investing heavily in innovation can get slashed all the way down to just 10%. That makes the U.S. one of the most attractive places on the entire planet for that kind of growth investment.
So when you put it all together, you solve that temporary cash squeeze, and you inject this massive hidden stimulus into the system, ARK believes you're setting the stage for a really profound change. We're talking about a transformation into a powerful, brand new economic phase. So the outlook is a shift away from what ARK has been calling a rolling recession. That's where different parts of the economy kind of take turns struggling, but we never get a full-blown downturn. They see the economy healing one sector at a time before it accelerates into a massive, productivity-driven boom, all powered by technology and huge gains in efficiency.
Now, this next part might sound a little backwards, but in this context, signs of a weakening labor market are actually seen as a good thing. Why? Because that's what puts pressure on the Federal Reserve to finally pivot and start easing up on its restrictive policies.
Let's take the quits rate, for example.
It's falling. That means fewer people are voluntarily leaving their jobs, which is a classic sign that people are getting a little more nervous about how easy it'll be to find a new one.
And at the very same time, the average amount of time people are unemployed is going up. It's just taking longer to find work. When you put those two pieces of data together, those are exactly the kinds of signals that could force the Fed's hand and make them reverse their tight money policies.
And that potential Fed pivot brings this whole entire argument full circle. It really challenges all of us to think about what forces are truly shaping our economic future. Is it the visible, headline-grabbing inflation that the Fed is fighting right now? Or is it these powerful, maybe hidden, deflationary undercurrents from technology and innovation? At the end of the day, that is the key question that this whole contrarian view leaves us with.